Good morning, everyone. Welcome to today's Wilson Pateras webinar. We'll just give a couple of minutes for everyone to join the session. It's just turned over 11 o'clock, so we'll let you all just quickly join before we get started with today's presentation. Well, thanks Larry for participating in today's session.
Pleasure to be here.
For all of you at home, Wilson Pateras, as you know, has run quite a number of webinars over the past 12 months, particularly owing to COVID. We've been blessed with technology to be able to provide various topics that are really important and relevant to our clients and other people out there in the community. And today we're joined by Larry Zhou. So Larry has got a wealth and breadth of experience in finance, so both in working with larger financial institutions and also in his own business more recently, helping clients, and particularly even Wilson Pateras clients, structure their financing and allow them to obtain the right sort of credit for all their particular circumstances. We felt today's topic was really relevant to introduce a discussion about with our clients from the perspective of we're hearing so much about particularly the property market. As many of you will be aware, property market seems to be going through quite a buoyant period. And a lot of that is tied to the way in which people will obtain credit and finance associated with buying property. So today's session will go for roughly 40 minutes. We'll try and keep within that time frame. As per usual, you'll notice there's a Q&A box, a question box. So feel free throughout today's presentation to put your questions up. We'll try and get them answered throughout the presentation. And we have a short poll as well. There's 3 polling questions. The polls give us an opportunity to understand better what your needs are and what perspective you're coming from in terms of your status within the property market in particular. So I'd like to start today's presentation by just giving a little bit of context to you all from the perspective of why we're talking about lending and the lending environment and opportunities. So when I personally think about the property market in particular, I try and think about 5 key basic measures of what makes the property market either a time to buy, time to hold, or time to sell. The first of those is the supply of properties in the particular area you're looking. So that's the first factor. What supply of both house and land is available in the particular area that you're looking at. The more supply will tend to indicate that the prices may be flatlining or dropping. The less supply would potentially mean the price going up. So that's the first factor. Second factor is demand. So demand reflects the number of people who may want to buy those properties that are currently on supply. Demand's often reflected in things like auction clearance rates. We see that typically when there's 70 or 80% upwards, that indicates a market that could be a rising market. The other factor is the equity that you have or the deposit you have. That's an important part of being able to commit to property in a safe way where you're not particularly risking yourself in a significant financial sense. The next factor is your income and salary. So having a secure income, a secure salary, that is something that the bank sees as being quite attractive from a borrowing perspective, but also from a perspective of giving yourself financial surety. And the final factor, which we're discussing today, is lending and borrowing. So where lending and borrowing has become quite topical at the moment is the fact that there is some legislation that is being considered to be passed through the Parliament, which will allow potentially people to borrow more. And there's a little quote here that I've got that's from the Senate committee that is looking at this legislation or the legislation that's coming up. And they make this note. They say the committee notes that a well-functioning credit market is essential for economic growth generally and for Australia's recovery from the COVID-19 pandemic. So it suggests to me that the government is very aware that opening up lending markets can impact and benefit people out there in the community to buy assets and probably a higher property price as a result. So on that note, without further ado, I'll go across to Larry now to do his presentation. Thanks, Larry.
Thank you very much. Thank you, Nick, for the invite, and it's a pleasure to be here. So yeah, lending has been a very, very hot topic lately, and it's very interesting because I suppose the supply of money or borrowing, whatever you call it, is almost a product that's not saleable on its own. It's always related to what the asset that it's funding, whether it's a business or property, and the rate and availability of credit suggests that's going to make big changes to how people view assets. So yeah, look, today I want to sort of go through two parts in the presentation. The first part is just to give everyone a bit of a rundown, as a general rundown as to what's happening in the market, what I'm seeing. In the second part, I want to make it a bit more relevant to people who are listening as to what I believe the top 5 opportunities are in the current lending environment, and how it can help property investors to grow their portfolio. Yep, Nick, can we? Yep, sure. So yeah, that's just a bit of a quote to start. Just like death and taxes, the only constant in the lending environment is change. And I think the last time I had a similar quote was when I was studying tax law, and they were talking about tax reforms. So yeah, here we go. Yep, can we? Yep, sure. So firstly, I want to talk about the forces that's driving a lot of the change at the moment in how banks and lenders lend out money. So first one, which is a very strong force, is regulatory. So about a year ago, we just came out of the Royal Commission. There were about close to 100 different recommendations, and the banks did a lot of work to adopt them. And arguably after that point, lending was at its most difficult point, where the banks were scrutinizing everything. See, the ghost of Royal Commission, in my opinion, is still lurking around, but we're getting to a point where, and COVID had a lot to do with it, we are on a recovery path. There is currently a proposed bill to remove responsible lending obligations from the National Consumer Credit Code. Now that is actually a huge thing, which I'll explain a little bit later on. Another change that's in place already is the implementation of the best interest duty for finance brokers. As you know, finance broking is a big industry in Australia. In the past, the standard that finance brokers were being held to was they had to make reasonable inquiries and make recommendations that were not unsuitable. So we have a double negative in terms of standard that was being held to. But now, very straightforward, you've got to act in the best interest of your customer. So I think that's a great thing. And in my opinion, I think a lot of the good professionals in the industry were doing that already. But I think to actually codify that is a great thing for the consumers and the industry. Second thing that I see a lot that's driving change in our environment is what I call lending appetite. What I mean by that is the bank's got a lot of data to work with historically, and they know which segment is the most profitable, which segment has the lowest default rate. And from what I'm seeing, there's a lot of movement to putting a lot more money to where they think good profits can be made and where the risk is also the lowest. And moving on, capital allocation is also driving change in the environment. So capital allocation is a little bit different to lending appetite. That's more to do with provisional capital. It's quite a specialized topic, and I'm not an expert in it. But essentially what it means is banks are governed by a set of rules on how much provision they need to keep aside for different types of lending that they make. So for example, if the bank lends $10 to a residential property, they only have to put aside $1 for every $10 they lend out. And those are not exact figures, right? I'm just using as an example. And if you were to lend out to a property development project, for every $10, you might have to put aside $4. Or if you lend out to a cash flow, if it's cash flow lending to a business where there's no residential security, you might have to put away $5. So that essentially explains where banks are willing to put their money, because ultimately banks still make the most of the money from lending. The more you can lend out, the less you have to put aside, the more profit you're going to make in the long run. And finally, I think is also something that is very, which everyone knows about. We've got record low interest rates. it is cheaper than ever to borrow. I used to get questions from customers: am I borrowing too much? Am I stretching myself? Now I tend to get more people telling me whether they're borrowing enough, whether they're taking advantage of the cheap rates. And with cheap rates, the overall investment yield, net yield, actually looks very different. If you're borrowing for 30% less, and in a lot of areas, the yields haven't really compressed yet. So you essentially the value of the assets it's become a lot more valuable because of that. Thank you. Now, I just want to go in a little bit more detail what these changes mean. So regulatory, we spoke about the removal of responsible lending. Essentially, that's just shifting more responsibilities onto the borrowers, and the lenders have a bit more freedom, a bit more self-will, if you like, to make a credit call on whether they want to lend to somebody. And it sounds like common sense, but it hasn't really been, especially after the Royal Commission, where there's some bizarre cases when if someone, midway through an application, if someone gets promotion in the same line of business or in the same job, they have to rerun the application because circumstances have changed. And it causes a lot of delays. I mean, there are also issues where, other examples where the banks were over scrutinizing people's living expenses. And I'm talking about line by line on their credit card statements and their bank statements, and making a call whether you're spending too much for what you're borrowing. There's also assumptions made from the banks that if you earn a certain amount of income, you need to be spending a certain amount of money. And if you are under that presumed threshold, they will look into your application even further. So it's just a lot of things didn't really make sense from those findings.
So Larry, is it fair to say in summary then, up until roughly 2015, 2016, say,
yep.
We had a sort of pretty consistent set of regulations when it came to lending. Brokers, banks, and customers alike all sort of knew what was required. Then probably a few royal commissions and so forth happened, and then what's been determined is maybe that wasn't the right mix of obligation on everyone. For 3 or 4
Yep.
years now, the laws have been much more stringent, a lot more obligation on the banks to
Sure.
tighten up what they're doing. But then now where we're at is maybe that pendulum swung too far. There's too many impediments to have towards people borrowing money for various things.
Yeah. What I would add to that is the responsible lending is actually a set of guidelines, right? It's actually very vague in nature. And after Royal Commission, I think the banks just started to put a very, very strict interpretation on what it really meant, and created their own policies to meet these guidelines. And probably, and in my opinion, it was a bit of an overkill because they didn't want to fall short of it.
Yeah.
And you're right. Prior to that, in 2000, I've been with the bank since 2009. And prior to that, I would say the policies and how they assess a loan application was a lot more consistent, and the changes weren't as turbulent. Yeah.
So I guess the message there is, if anyone on this webinar, when you're making a loan application, if the process is more complex than you expect and difficult, and things get thrown up from left field, that's normal. Yeah. Don't go in expecting a seamless process.
Yeah, and I think where a lot of connection is lost between customers and lenders and banks is when customers explain things, and it makes common sense, makes so much sense, right? To not agree with the bank's decision, but it all gets lost. Very rarely, do these decisions get overturned.
Cool.
Yeah, and that's just a bit of a quote from our treasurer, Mr. Frydenberg. So he referred to the lending framework as an overly prescriptive set of obligations, which had stifled the flow of credit, and the guidelines, which led to lenders being really careful about lending out money. Okay, now I spoke about shifting lending appetite. This is a chart that I took from the 2020 Westpac investor presentation. It talks about the segments that that Westpac lend money to, so their total exposure in different segments of the market. As you can see, I've got the industry on the left and the exposure on the right. So if you look at retail trade, it's 15 billion. I mean, retail is huge. I mean, everywhere you go, I mean, you see retail, right? And we're at 15 billion in total exposure, which is a big number, but probably not massive in the scheme of things. You've got health services, construction. Construction is not to be confused with property development lending. Construction is lending to the construction industry, so builders and tradies. Then you've got cafes and restaurants at about 10 billion as well. Then you've got commercial property at 65 billion, which is pretty significant, and that includes property development and long-term commercial assets. Where it's really dominant, you can see the last line is mortgages. We're 440 billion, probably 4 times more than the rest.
So what we're talking about, if you're an astute investor or somebody who's wanting to understand the property market better, the residential property market, what I gather from that is that understanding the residential lending market within the big 4 banks in particular will give you a good sense as to where the property market might go.
Yeah, I think so.
If big 4 banks are going to lend more, then potentially the price will rise. If they're going to lend less, the price might reduce on that.
Yeah, I might stay on that point for a little bit longer. And this trend's been going on for quite some years. And a couple of things that a lot of people could relate to, right, is if you listen to the radio, you basically hear all the banks advertising, residential lending more than anything else. No bank ever gets on the radio or TV and talks about lending to cafes and restaurants, right? It's always very specifically focused on your home loans and your investment loans. And the reason for that is because Australian property traditionally has had one of the lowest default rates. The banks, even though the rates are cheap, but the banks and the capital you have to put aside is very little, it's still very profitable in this area. And as a result, because all the capital is being shifted into that area, a lot of small and medium businesses are finding it very difficult to access lending, especially when it's unsecured. And
in our experience, most clients, if they're going to make an investment in their business, but for equipment finance, quite often it's essentially property-backed residential finance that's committed towards a business. It's not really standalone business credit.
Not really. Even if they do give you a business loan, they still want to have residential security.
Yes.
Because it's still the security, the underlying security that the banks feel comfortable with.
Yes.
Yeah. Yep. Yeah. So since we're on the topic of residential lending, I might just quickly go through what the banks are looking for and what the banks are always looking for. So firstly, you want to have a reasonable credit record, credit score. If your score is over 600, 650, usually don't have any issues, right? And you can easily access your score by going on one of these websites and ordering one of the reports from Equifax. Second thing the banks are looking for is the security that you're putting up for the borrowing. Usually, if it's 80% or less on residential property, they don't need insurance. And the easiest way to explain that is when someone buys a home. They buy a home, they put in a certain amount of deposit, and as the bank lends you the money to buy it, they've taken a mortgage over that property. Third thing they're looking for is what they call serviceability, which I'm sure everyone here hears about quite often from their bankers. That essentially just means, do you have enough income to support your debt? Which is probably the thing that self-employed clients struggle with the most out of all other criteria. Since I'm on that topic, I might just quickly mention COVID-19 considerations. Different banks have different view on how they view income when the client's gone through COVID. If you're PAYG, obviously it's pretty simple. They look at whether you still have a job or not. If you're self-employed, it's a bit tricky. They might look at things like They might look at your current BAS compared to your old BAS and see if you're still trending, if your revenues are still stable. By certain industries, the banks are happy to take a risk. So if you're a doctor or a dentist and you run your own clinic, they probably don't need any of that. They'll still rely on your 2019s. And finally, which is also actually a big one that the banks look for, is for residential lending is the purpose of the loan that you're asking for. It sounds straightforward, but not always. If you're buying a property, the purpose is straightforward, right? If you want to refinance, purpose is straightforward. But a lot of times people have equity in their homes. They might want to use a bit of money to pay off a tax debt. They want to use a bit of money to invest in a business. They might want to borrow some money to build a couple of townhouses. Different banks have different appetite on what is an acceptable purpose under the residential lending banner. Implications of low rates. As you can see here, I've just taken the CB8 standard rate. It's gone down in trend with the Reserve Bank rate, right? So that's fairly consistent. Now, can we move on to the next slide? Yep. So low rates, in a lot of ways, mean more attractive investments. So spoke about this a little bit earlier. If the yields are maintained, borrowing costs are decreased, naturally the asset becomes more attractive. And lower rates with a lot of lenders actually have increased the borrower's borrowing capacity, because lower rates means lower repayments. So in their calculation, there's a bit more room to.
One of the big questions we always get asked as advisors is, the rates might be low now, but will it stay that way? And this is always it's a bit of a $1 million question. No one knows for sure. I mean, I often, if someone asks me that question, my insight into it is to point to the Reserve Bank guidance. I feel like that's probably the best source of truth, and look to see what they have to say about the matter. And they keep reminding that they're committed to zero overnight cash rates until 2024. What's your sort of view on how should our attendees today be thinking about interest rates? Because one of the concerns people often have is they say, look, I buy on today's interest rate of whatever the headline rate is, 2.5%. But if the rates go to 4%, I'm concerned I can't afford to meet the ongoing requirements of whatever asset I buy. So what would your advice be in that?
Yeah, sure. So I'll probably look at this from a few different angles, right? I think rates, when a rate goes down to a certain point, it actually changes the asset structure. So if you look at when I was in 2009, rates were 6, 7, 8%, and gradually it's gone down. And there's a lot of reasons for that, right? There's a lot of things that happen globally. But one thing I rely on is our Reserve Bank places a lot of importance on our economy. The rates are always, I suppose, adjusted or tailored to what's best for the economy. So right now we've got a bit of a guarantee, I suppose, where the rate's going to be very low for the next 2-3 years. And I would say, take advantage of those fixed rates, get a bit of certainty, right? And the best rates are always available for principal and interest repayments. So pay down a little bit of principal, decrease your debt. But hang on, let's look at it the other way, right? If rates, what would trigger Reserve Bank to increase rates? I think it's because things are going too well.
Yeah.
If your rates are going up, I actually think in some ways a good thing, because it means the market's buoyant. People are spending money, and your asset value has probably gone up a lot too.
I agree. The concern people have around rates is often, I think the concern people have around rates is often a legacy of perhaps that early 90s period. It's probably before my working time. The people during that period certainly relay a lot of stories around the fact that the rate was virtually punitive, and it was something that was almost forced by the government. The government encouraged a punitive rate of interest in order to stop a very overly buoyant economy, overheating economy. And I guess what I'd probably advise most people, a bit like what you're saying, is to look to the most recent history. I mean, COVID-19 is a great example of all of the different bodies, legislative, political, bureaucratic, kind of
Yeah.
working together to ensure that there's a best result for Australians. And that's probably the thing I think you can point to. If rates are going up, probably indicates your property's worth, or if you're buying a property, you're probably worth a lot more than what you paid for it.
Yeah.
Because
and there's also
inflation's
very
happening.
strong, sorry, Nick, there's also very strong evidence where there's a correlation between rates and yield.
Yeah.
So if rates were to go up, I would suggest a lot of the investments that you have will probably be yielding a bit more too.
Yeah, the income return, as in, your rent might have started at $500 a week and now it's $550 or $600 a week. So that might pay for that extra interest. Yeah.
Yeah, I mean, if you look at the rental yield on a lot of the, let's just talk, say, residential for a second. If you're talking about residential yield on a lot of different types of properties, yeah, some yields have gone down, like CBD apartments. Yeah, you'll be taking a 30, in some circumstances, 40% cut. I mean, I've got clients who own rent roll books in the CBD, and they're struggling. So something I was renting out for 500, you probably get it for 360, 370. In that scenario, yeah, it's gone down, but there are assets that haven't, right? So you might have properties in Mornington or even just in the suburbs, in the metro suburbs. The rental yield is definitely not going down, and the banks are funding all those assets at the same rate. And I think as an investor, obviously be smart about your asset allocation as well. Yeah. Now, moving on to the second part of the presentation, I want to make it a bit more relevant to everyone who's attending this. I want to talk about where I believe the opportunities are, top 5 opportunities in the current environment. So number 1, I think feels like we're repeating the same thing again here. Take advantage of the increased yields on investments. Again, if yields are still similar, finding good assets, the interest rate's gone down, probably if you're willing to fix a principal and interest, it's probably gone down 30, in some instances 30, 40%, depending on the type of loan you want to have. And I think that goes pretty much straight to the bottom line. We used to do forecasts with clients, and negative gearing was always a part of it. Now you do the numbers. I think with newer properties and you pick it up for good prices, I don't think there's much negative gearing at all, unless you use the depreciation. Is that fair to say, Nick, what you see in your clients?
I think so. I think if you're talking about just using some simple numbers, I mean, the rental on a property might be 20,000 a year, and the interest cost might only be 15,000, and that's because the rate of interest is just so low. If it's newer, there might be some depreciation, other costs. It might be a small negative gear, but it tends to be something we see less of these days. And also, I also think the other aspect of negative gearing is deposits are generally required at a much higher amount. So there's probably more equity and less debt in properties than what might have happened previously. Like we were seeing 10 years ago, 90% LVR, 90% lending against the value of an asset was reasonably common.
Yep.
Because now it's an 80% or lower in a lot of cases.
Yeah, the banks obviously feel a lot more comfortable at 80. I think the exception probably comes in with a lot of first home buyers, where the governments are giving so much incentive. So that kind of makes up the deposit, and they're guaranteeing, the portion that they're borrowing, which requires mortgage insurance. But that space is a different space, I would say. Yeah. And moving on, obviously commercial property as well. The banks are loving assets like warehouses, industrial properties, and essential retail. And for big size assets, you're sort of looking at rates. Commercial rates are in the low 2s. And if you've got a factory or a Woolies or Coles that's yielding 4 to 5%, the yield's almost doubling your interest costs, which is very significant. In my opinion, it changes the asset, changes the structure of the asset, and over time, I think the yield will have to be probably compressed.
In a general sense for the audience, what's the difference between a interest on a commercial facility or interest rate in a commercial facility for something like that versus a standalone residential property? Is there sort of the margin that would often I would say expect to be different?
Sure, I would say with commercial properties, right, it really depends on the size of the debt, right? That makes a huge difference to the price. So if you're borrowing if you're buying, say, like a corner fish and chip shop on a secondary commercial strip, you're not going to get very good rates, right? It's not very attractive. But if you buy a Dan Murphy's or a Coles or a Woolies, and this significant size debt, yeah, you're getting probably home loan rates probably lower than home loan rates.
Right. Okay.
In the low twos.
And that's because the bank's saying, essentially the bank's saying to the market and the customer that the quality of the tenant in that instance,
correct, it's so strong,
good that the default risk, the chance of the tenant not being able to meet the commitment is lower than a person who's a residential tenant.
Absolutely. Yeah. And another thing with commercial property is you can do standalone servicing. So what that means is the best example to give is for example, let's say myself, I can't borrow anymore on residential properties because my income is only enough to support what I currently have. But I buy a commercial asset and it's got good rental yield. The bank will assess that standalone to the rest of my portfolio. And if the rental is enough to wash the face of my interest or what I want to borrow on the commercial property, it can be done separately. So that's where a lot of
residential, where the bank will take into account the rental, of course, but they will then want to see tax returns, and we get this all the time at the moment. We're very busy doing the requests. They want tax returns showing servicing. So whether from a salary or from a business, they want to see that servicing capacity to support the residential property purchase.
No, and the servicing is very different. On residential, they want you to service it over 30 years on the basis that you're paying down principal over 30 years. In commercial, it's so much simpler. All I look at is they assume your loan is going to be interest only for a long time. So they just assess on an interest only basis. So your repayment is obviously a lot less.
Yeah, makes sense.
Yeah. And sorry, I might also touch on the fact that, so you know how over the last 10 years, we've had a lot of foreign investors buying good commercial assets in Australia. And that's the concept and policy they access, is that standalone, because they don't have any income in Australia. But with the rental income that's coming in from a Dan Murphy's, the banks still happily lend it to them. Yeah. Now, second opportunity I see is obviously rates, right? Take advantage of the competition in the market, right? I mentioned earlier, everyone's talking, everyone's competing for home loans, right? You hear on the radio and TV all the time, there's rebates, there's, they cover your fees, they give you better rates, good fixed rates. And why is that happening? Goes back to my earlier point, heavy capital injection in that segment, because the banks just love it. It's low cost for them to maintain, and it's low risk.
So just to give the audience a sense of why that's the case, and I'm not an expert in capital markets myself, but I think it's good for people to gain context. My understanding of it is that a bank, an institution, will take money from different places. Roughly half is from international money markets. They go out to around the world and buy money, buy debt. And the other half is roughly from consumer deposits and even the reserve overnight cash facilities they have. And so what's happened over the past 12 months in particular has been this explosion in new money being created, both overseas and in Australia. All this new money's put out there, so the banks can go out into the marketplace and buy cheap money, in effect, to re-lend out there. Is that a fair summary of how?
Absolutely. I mean, I speak to the banks all the time, and what they're telling me now is that the banks right now are definitely not short of capital.
Yeah.
They just need to find a way to lend it out, and lend it out to good businesses, lend it out to good home loan borrowers. So they've got plenty of capital. Yes, that's really just not an issue because of what the Reserve Bank's doing, what the Fed's been doing.
And that's been that's probably the past 6 months, isn't it? It's a more recent thing. It certainly wasn't before COVID. It was a different capital market for a bank. So the banks now have a lot more money to lend out, and they want to lend it out, is what you're saying.
Sure. I mean, I deal a lot in the property development space for property developers, and the conversation we were having during COVID was, we're not interested in doing any deals with new clients who's coming on. We just want to support our existing, but even then we're very selective. We want customers to hold back on projects because we've got to put more provisioning onto in case things go bad. But now the shift is so tremendous. They're just really keen for new business, and this is probably the side of the major banks that you don't see from the outside, because it's not what they advertise in commercial banking. All you associate with the major four banks is all to do with home loans and investment loans and we've got a really special deal here. We've got a massive rebate there, and it feels like the appetite is always consistent, but in other areas it's actually not. And capital is a huge thing. Yes. Now I just want to give an example on. Actually, I might throw that to the audience. Anyone who's on this webinar right now, I challenge you to do something. If your home loan's been with your current bank, I'll say for more than a year, if it's been 2-3 years, definitely will be the case. But even if it's more than a year, check your rate, and then go to a new bank to get them to give you a quote on what they're happy to, what rate they're happy to give you for refinancing to them. I would pretty much guarantee your old rate's going to look pretty average. Your current rate's going to look pretty average. And I just want to spend a bit of time explaining sort of what happens, right? So I've got an example here. So you've got Tom, got his investment property 3 years ago, and got an investment loan from a major bank. RBA was back then 1.5. Standard rate was 5.79 for Westpac, for the bank that he got it from. At that time, he got a 1.45% discount from the standard rate. It ends up with a rate of 434, and that rate is a variable rate, right? To be clear, but the discount of that 1.45 is a discount for life, right? So that's it's good marketing from the banks. We've got a discount for you for life, as long as you pay the package fee or whatever every year. Now, 3 years later, we're at 2021. So RBA's dropped their rates to 0.1. So that's 1.4% from 2018. Now, Westpac's standard rate is now 5.13. So they haven't passed on the whole 1.4, which we're very familiar with because the media is very big on, saying, oh, they only passed on 0.1 out of the 0.25, right? So Westpac's standard rate is now at 5.13. And Tom, our customer from 2018, is now on 3.68 with the same discount of 1.45. Okay, so Tom's rate's been going down as well. The bank hasn't, increased his rate or anything. But now let's look at a new client. So Jerry recently refinanced his investment property to Westpac with the same loan amount. So everything is comparable. But Jerry has been offered a discount of 2.04%, which equates to a final rate of 3.09. So with that example, what's actually happened, right, is the bank has effectively back-priced their existing book without having to notify anyone.
So as a bit of a sort of summary, is it fair to say that the bank will rely upon a long-term customer who they may not pass on, firstly, they may not pass on the full rate of interest, and secondly, they haven't given the highest possible discount. They'll rely on a bit of profitability from those clients to perhaps subsidize a new client they're trying to attract. And therefore, as a result, there's an incentive for customers to continually review and ask questions about their level of interest rate they're paying.
Well, if you look at the bank's profitability, I definitely do believe that if they were to give everyone the same rate that they give to new customers, they'll be nowhere near as profitable.
Yeah.
So that's just and it's no different, I suppose, to phone companies or internet companies. If you look at your internet plan from 2 years ago, if you don't call them up, it'll just keep on going. But you find one day you call them up and they say, oh, you can actually be on this plan, which seems like so much better deal. But I think for businesses where there's revenue that's just kind of been ticked over, it makes sense. It's not uncommon as a strategy to model that business on that basis. Yeah. Third opportunity, take advantage of different lenders' niches. What do I mean by that? So the banks and lenders are becoming smarter and smarter on how they compete for customers. They don't all want to just compete on the same thing. So if everyone competed on just rates, then we probably only need one or two banks. Doesn't really give anyone space to survive. So the banks compete on different things. So rates is the most obvious one. They compete on servicing. Pretty straightforward. Same set of scenario. One bank will give you $1 million in lending. A different bank on exactly the same scenario will give you 1.2. So they'll win that customer, even if that customer had to pay a little bit more. They compete on the type of security they take. A good example, I think I spoke to Nick a few weeks ago, was small apartments, right? So if you've got a apartment that's under 50 square meters, a lot of banks are not going to take it, but CBA will, regardless of the size. Or if you want to build, 3 townhouses on a block and retain it for long-term investment, well, most banks probably won't do it, but there's probably one or few that would, for residential purposes. They also compete on purpose, right? So, for example, for one bank, you might say, I'm cashing out money on my home to pay ATO tax debt. For a lot of banks, that's not acceptable. So purpose is can get quite tricky and complicated. And I suppose lastly is I think policy is a huge thing, especially on self-employed clients, and how self-employed clients tend to have lots of different entities, especially if they're sophisticated. They might have debts under different entities. How different banks treat those debts and your personal guarantees to those debts can probably make all the difference in whether a deal work or not. So sometimes just because your current bank says, oh yeah, it doesn't really work for us, we've got to look at all your debts and look at holistically, it doesn't mean everyone has to. And I've just got a quick servicing example here. So between a major and alternate lender. Major, I'm talking to major 4, including Bank of Melbourne. Alternate lender, we're talking about, don't know if you guys have heard of lenders like Zhou, Pepper, Liberty. They, a lot of them are foreign owned, and there's a lot of private American equity behind them. But they made the decision years and years ago to get into the Australian lending market because traditionally it's such a low default rate. And these decisions are made by private equity investment bankers, people much smarter than myself. So yeah, they obviously think it's a good area to be in to lend to Australian property. So just a quick example: married couple, 2 kids, buying a 30 investment property, limited cash 150. They've got 3 properties already. Total existing loan of 2 mil. So there's a mixture of own occupied 800 and investment of 125. Wife's on 150, husband's on 106. How much can they borrow for the 3rd investment property? For simplicity purposes, right, I'm just going to assume all loans are principal and interest with a repayment of 30 years.
Yeah. So that is a pretty typical scenario. It's a very representative of many of the people who may be on this call or the people that
very typical. Very typical, and I would say the client is typically in high 30s or low to mid 40s, wanting to build an asset, build a property portfolio for their future. They probably have high expenses because they have kids maybe entering primary school, maybe high school, so they don't have Okay, so just a comparison for a major bank in that scenario, you'll be able to borrow 520. But with an alternate lender, give you a bit more.
So is it fair to say, once again, as a bit of a general rule, as a takeaway for the attendees today, that a major bank will probably, in many scenarios, lend a little bit less to a customer, but their rate might be slightly better. The cost of their debt might be slightly lower. A non-bank lender is probably likely to have more debt, but a higher cost. Is that a general rule, or is that not the case?
Nail on the head. So basically, if I'm a bank and I want to charge high rates, but I'm not willing to take more risk and lend people more money, or I don't want to accept certain types of income, then there's no way that lender will survive.
Yeah.
So everyone's got all their niches, and as a general rule, the cheaper the loan, the more restrictive the lender would be from a lot of angles. So there are a lot of online lenders. I'm sure.
Because I know a lot of people talking to over the years, a lot of clients, they might feel a little bit hesitant to borrow from a non-bank lender or an alternative lender. And my advice often has been to them to explain it's a means to an end, as in you might be required to do this in order to get to the next step in where you want to go. Sure. And you can probably refinance that asset back to a major bank at some future point. You don't need to treat it as a permanent thing, because I often get caught up on rate. They might say to me, oh, Nick, but they're going to charge 4% and I can get
Yep.
2.9 at a major. And my response is to say, but that 1%, what's the opportunity cost of missing out on the opportunity to do what you want to do?
Yeah,
and that 1% extra you're paying might only be for 2 or 3 years. I mean, you can probably refinance back when your circumstances change, when your income increases, when you have more equity.
Absolutely spot on. And that's what I've always say to customers, like lending is, you can't look at it in isolation to the asset that you're funding. Like it's a product that's on its own doesn't make sense. No one wants to get it. No one wants to have a loan for no reason, right? So you've got to look at the asset that's attached to what you're borrowing for. And another thing I might add on that is a lot of the lenders are really, really cheap, right? There's no way majors or alternative lenders can compete with them. But you got to understand, they're after a certain type of customer, right? They're after the type of customer who's got a house that's worth, $1 million. They only want to borrow, 500, and they're not really looking to do anything in the future. They're not looking for property investors who's wanting to grow a portfolio. Those lenders they want a certain type of customer, so it makes sense for them on their risk-adjusted rate.
You probably say, in a general sense, they're probably a more static or conservative customer.
Absolutely.
Someone who's less willing to transact frequently, whereas the alternative lenders are more equipped for people who are being more entrepreneurial. They're probably wanting to do
I think that's a very
more deals, take on a little more risk.
Very fair,
very
fair
more
comment.
quickly.
Yeah. Basically, as a rule of thumb, low interest rate, very, very cheap lenders, and a lot of times the majors, they want everything. They want vanilla deals. They want everything stock standard. A lot of them won't even take self-employed clients. Fourth, opportunity. If you've owned property over the last 10, 20 years, the odds are you've gotten a lot of equity. Even the last 2-3 years, you would have got a lot of uplift in your property value. I think right now is probably a good time to take advantage of the equity that you've built up, and if it's something that you believe in, you want something you want to do with the money, whether it's buying a commercial asset, resi asset, even just to invest in equities or something you feel comfortable with. Obviously, speak to an accountant and planners with. I think now is a perfect time to look at restructuring your debts to use those equity. And the reason for that is overall the banks are pretty flexible on how you use your money and the features that the loans offer for that arrangement to be in place.
I guess part of where the advantage of where you sit in that equation is that it's the old thing that the broker has the potential to talk to a number of channels and know where their appetite sits, where you can get that.
Yeah,
that funding
absolutely.
through.
I mean, as our business, where we're not a bank, where we don't own any financial products, but we're basically accredited to sell all these products, right? And that's really powerful in the sense that if one lender can't give you what you want, well, the market has options. Yeah. And finally, there's one thing. Sorry, Nick, can you just go back one slide? Just touching on the last point there, I said extending iron loan terms, right? That's something I think people should be aware of. Is a lot of times when people get a loan, they get an interest only loan. That's it could be 5 years. In the past, you could have interest only for 15 years, and you kind of just forget that one day it has to become principal and interest if it's a residential loan, right? And the thing is, the longer you've had interest only, the bigger your repayment's going to be when it becomes principal and interest. All right, because the total loan term can't exceed 30 years. Right, so the amortization is much bigger from a number point of view when it becomes principal and interest. So I would say review those terms, make sure you know when they're ending, and if they're ending soon, use this opportunity now to restructure it, maybe get a longer IO term, but stretch out your loan, especially if it's an investment property and you're not too concerned about paying it down in the short term. Perhaps unlike a home loan, yeah. Yep, and finally, I would say take advantage of your recognised professional status. So if you read the advertisements and the ads that the banks run, banks love all their customers, but I think in reality they probably love some customers more than others. So if you're if you're a medico, if you're a doctor, dentist, or a pharmacist, you're an accountant or you're a lawyer, I think you do get some pretty decent preferential treatments. You can borrow more for less deposit, and a lot of times, I think it's a little bit unspoken, and there's no policy written, but I think a lot of times they're just much more willing to make an exception to fit your circumstances, which they will probably never do for other professions, right? And a lot of these professionals that can borrow for 90% without having to pay mortgage insurance. And over time, if you were to build up a property portfolio, you can probably get into your next property a couple of years earlier because you don't have to save for that additional 10%. And I mean, if you believe in building a portfolio in the span of 9-10 years, probably makes a huge difference as to your net position. So yeah, that's basically all from the presentation for me today.
One final question,
hope
Larry.
You enjoyed it, and thanks for listening.
No, thank you very much. Appreciate your insights and your views. It's been interesting. I certainly, whenever I talk to you, even just normally, I always learn something new about lending. One of the questions that we've got is, you've seen a lot of different people over the years as customers. Some are more comfortable with borrowing than others.
Yep.
They've gone through a different journey to extend themselves. First part of the question is, what makes those people more comfortable with debt than someone who's not comfortable with debt?
Sure. No, that's a great question. It's really good question. I think a lot of it is, I think it's two angles I look at it. I think one is background. So if they grew up and people around them were property investors or invested in businesses or run large development companies, I think they naturally have a very good appreciation on the concept of leverage returns.
Yep.
I have clients who I actually have to try and hold them back from borrowing too much because they just have no fear of debt. They don't believe. I suppose intellectually they obviously understand that debt has to be paid back, but they just think not using their borrowing capacity is a waste of not making the most of their leverage returns, right? So property developers, they just don't like seeing cash around because that's what they've seen when they're growing up. Property investors who have built enormous amount of wealth just from not selling over the last 10-20 years. The way they see it, a lot of them, you talk to them, they're probably in their 50s, 60s, some in their 70s, and the papers calling doom and gloom during the GFC and also during COVID, probably, and they don't even flinch, and they just say, look, I've seen it too much. It's at the end of the day where the government will bail everything out. There's going to be a lot of money printed. Where's it going to go? It'll still go to go into these good assets. So I think that's one thing, is where you've got personal experience.
Often it's a belief system, isn't it? It's what you believe. People have a belief system around acquiring debt other people may not.
Sure.
I find there's a mindset difference. There's a way of thinking that's a little bit different to others. Yep. The second part to that question is that those who do take on significant leverage, have you seen some adverse things happen? Have there been some really bad consequences? And what's often the worst of it? Like if someone was to over borrow, what happens next?
Okay, if someone were to over borrow, I think the first risk that we discuss with clients is you got to make sure you've got a way of repaying the debt. And it's a very different conversation depending on the type of debt it is. If it's residential property, then yeah, we're going to be having a conversation about your ongoing income, whether you've got enough ongoing income to support it. And if something were to happen, so your business were to take a hit and you can't make that amount of money, or if you lose your job, then are you prepared to sell some of your assets, right? And if you do sell these assets, have you taken into account potential taxes you might have to pay, especially if you've made a lot of money on capital gains?
Yeah.
So that's one way we look at it. Another different type of debt could be property development, where the debt is not really repaid back from your income sources. It's repaid back from the end rental of the property plus potential sale proceeds to clear those debts. And I mean, the riskier the venture, I suppose the more return there is at the end, the higher the risk, right? For that particular person to undergo to take on more debt. But I'm just thinking, every year as a business would probably write about $250 million, give or take, every year. Have we seen anything go really bad where there's a for sale or? No, I actually can't think of one. There's never been one.
Because and in my experience too, I've very rarely seen an incredibly difficult situation. It has happened in very, very rare cases. To me, what tends to happen is it's more a negotiation. So the person who holds a lot of asset and a lot of debt has to negotiate with all the parties, including the bank. It's the days, I think it's another mindset thing. I think people are perceiving that perhaps the environment still exists where banks have really nasty forced sales. And I don't think that's where we're at anymore in terms of the bank's relationship with customers. It's more a collegiate negotiation to say, right, we now need to manage this.
Yeah,
because you're outside our parameters.
I mean, I've seen things don't go right. Like, for example, property development deals where they end up, not making any money or lose money. But a lot of times, the loss is absorbing the equity that they put in, and usually they'll sell it before the banks get to it.
Yes.
Where a lot of the mortgagee in possession scenarios take place is when I think a lot of times it happens where there's multiple parties in that transaction. And they can't agree on what to do, and then at the end, the mortgagee just takes over and go, we'll just get rid of this.
And I have seen that. Yes, complicated ownership structures, absolutely. Yep.
Yeah, so the debt can be frightening. I get it. A lot of people are not comfortable with it, but it's I suppose just and personality has a lot to do with it. Some people are just a bit more a bit more conservative. Which is okay. You just do what you feel comfortable with, and some people are naturally more aggressive. I mean, I've got clients where they just don't like seeing cash on their books. When they see cash, they think there's something they can do, and when they want to do something, they want to borrow money. And if you do it right, these are sort of the clients who have made the most amount of, have got the most amount of upside over the years.
Well, thanks, Larry. We'll have to leave it there. We have gone a little bit over, but I think I've certainly enjoyed the conversation. I think our audience has as well. There's been some really great insights, and I appreciate you're in the middle of dealing with a lot of people who are doing some interesting things in property, and that's why we got you forward for this presentation. So if anyone who's attended today would like to talk directly to Larry, I'm sure you'd be more than happy to have a chat around everyone's individual circumstances and what they want to achieve. So thanks very much. Thank you all, most importantly, out there for attending as well. We're really appreciative of your support of our business, and we hope that you've got some great insights out of today. So thanks, Larry, and thanks, audience, and we look forward to seeing you again soon.
Thank you very much. Thank you, Nick. Thank you for the invite.
No worries. See you.